Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Welcome back, everyone, to the CreditSights No More Risk Better podcast. My name is Logan Miller. I'm the head of European strategy based out of London. Today is going to be our first of the year Euro-focused podcast, and I'm pleased to be joined by my colleague, Mary Pollock, who is the head of real estate in our European office, covering a wide range of names. Mary, I'm very happy to have you join us today.
Hey, I am excited to be here.
All right. So, it's been a busy couple of years for you, for sure, in the real estate space. It was once sort of the unloved sector across European credit, seems to have, caught in a bit over the last couple of years. And I'd be curious if you could just kind of help set the stage in terms of what stage of the cycle that you think that real estate is currently in.
So we reached the trough in commercial real estate valuations in the middle of 2024. So I think we're over 1 year, approaching 2 years out of the trough in the reflation cycle. And when I refer to the reflation cycle, I mean the step down in CRE prices from mid-2022 to mid-2024 related to the change in expectations for inflation and, of course, the change in interest rates. If you look at this period, so you could say it's sort of early recovery, real estate cycles are long, versus the GFC, the return in transaction volumes and the appreciation we've seen in property prices has been slower. So we are headed in the right direction, but it is really slowly on two of the counts we would look at for the sort of overall health of the sector being transaction volume. So the amount of properties changing hands and the extent to which we're seeing property prices increase once again. And then there are differences when you're looking at geography and subsector, but if you're talking about European CRE as a whole, our first couple years of that recovery stage and looking for further recovery in 2026.
Yeah, that's really interesting points. I think if you look at just where kind of credit valuations are in general from sort of secondary market, we're basically sitting at now new kind of post-great financial tights. So I think it's really kind of interesting to see how the credit cycle across more broadly in Europe is sort of different from what we're seeing on the real estate side. But you mentioned it's not entirely broad-based and consistent. What are some of the differences you're seeing at sort of the subsector level, or even if it's sort of the country level, any sort of nuances there?
Yeah, so offices, in terms of the large subsectors, remains the one where it's the most unloved, or where there's the greatest uncertainty. It saw the greatest step down in terms of peak to trough valuations. In some cases, you've seen a further erosion in property prices, so you haven't seen those valuations increase yet. Also, when you look at transaction volumes, you're at really very low levels versus historical averages. So those transactions have not really kickstarted yet in the office sector. That uncertainty is still impacting how many investors want to be buying and selling in that space. On the other side, by subsector, the joke is that Europe loves beds and sheds, and it is residential and logistics, where I'd say we've seen the most strength since the trough in valuations in 2024, although there has been some variety in terms of timing over the last couple of years. And then what's interesting by geography is if you look at last year in particular, some country-specific issues in, France and the UK stand out as weighing on transaction volumes in those markets. And in some ways, real estate can be very sheltered from geopolitical risk or certain macro risks. Like, for example, when tariffs were on everyone's mind, it was not at the forefront of tariff concerns. But when you have political or some macro uncertainty at the country level that will influence transaction volumes. It will just slow the pace at which an already relatively illiquid asset class is seeing deals get done, because obviously investors want to pause, wait and see what's happening before deploying large amounts of capital for an acquisition, say. So that's what we saw last year, and that's something to bear in mind as we go into 2026.
All right, so let's kind of shift the conversation a little bit. I mean, one of the big kind of macro considerations in your space is obviously interest rates, and we've seen a pretty substantial move higher, I'd say, at least in terms of kind of benchmark yields across Europe over the last 12 months. I think there's a number of reasons for that. One, we've obviously had expectations for some pretty pronounced fiscal stimulus out of Germany, which is, I think, pushing up the term structure of rates more broadly. I was looking at my sort of monthly recap this year and for January, and it looks like bond yields are up almost 80 basis points at the 10-year point of the curve over the last year. Now sort of hovering around 2.85. Mary, what are you thinking about in terms of the impact this is having on kind of real estate, broadly speaking? Any sort of negative read-through, just given how rate sensitive your sector is?
Yeah, that's a good question. And it comes up a lot. I would say, in general, my companies are much more positive on the overall rate environment, which is not surprising. The stability we've seen in terms of front-end rates, in terms of expectations, should, in theory, provide some support, especially for deal making, for underwriting deals, cost of financing. Like, it should be helpful. And so I think a lot of the issuers are relatively positive versus where we were in 22 and 23. That being said, what's happening to government bond yields, it can't be disregarded. Real estate is a yielding asset class. This has important implications, in a variety of different ways. But if you think about the attractiveness for a fundraising perspective, like for if you are a CBRE or a Blackstone looking to fundraise, how attractive do European real estate property yields look when the risk-free rate is rising? What does that mean for risk premium? What is a fair risk premium? How should that filter through to valuations? Those are all questions that come up and need to be answered. There are also differences by subsector. So I would expect this to be more of a concern for low cap rate sectors, the most important in Europe being residential. So it's definitely something we keep an eye on. But in general, I think overall, the environment definitely more supportive. It just is another one of those factors that's sort of slowing that rebound, keeping this from being, a strong and steady improvement from the trough, and more of a very slow and sort of spotty improvement from the trough in valuations.
Yeah, definitely. I mean, do you think the higher yields are having an impact on sort of the ability of companies to raise capital in the space?
I don't think so, not in the bond market. I mean, the bond market seems very receptive to European real estate issuers. And if anything, what the companies are saying is the bank market has become more competitive. So if you look on, the lending side, the credit side, there's major lenders are happy with the current environment. I do think it's important to bear in mind that interest coverage ratios are an incredibly important credit metric for European real estate issuers. So just in terms of sheer cost of financing, historically, we did have relatively long duration bonds coming from the real estate sector, especially from the more defensive names. But if those are much more expensive, then we're not going to see that supply, because the companies need to manage their interest costs really carefully still in this environment. So there's, a little bit of nuance there, but I think it hasn't really impacted their ability to raise funding.
That's really interesting. Yeah, I mean, I think if you go back to like 2022, it was really all about like the rate shock, and the rate of change was just so pronounced that like now it's
Yeah,
been sort of
so
a
severe.
slower grind higher in terms of borrowing costs. But yeah, those are really interesting points, I guess. So let's move on to like sort of capital allocations. How are you sort of thinking about this, in terms of your outlook for 2026?
I think this is an interesting question, because I think it's one area where we're seeing the most change, especially at the issuer level. So obviously, through the reflation cycle, companies battened down the hatches. Liquidity was paramount, and we saw a lot of moves to divest assets, essentially play defense, shore up the LTV, do what they could to get their credit, the balance sheet in a strong position as possible in a tough environment. And now companies want to spend again. That comes in different forms, but whether it's investment, shareholder returns, I feel like, especially for performing IG names, management teams are like, okay, we are done playing defense, and now how can we put some of this balance sheet to work? How can we find opportunities, or should we be thinking about rewarding shareholders? And it does make me a little nervous because balance sheets are weaker. I mean, LTVs are higher, ICRs are lower. ICRs are going to continue to get lower because of the refinancing of legacy low-cost debt. So it's definitely a balance to watch, I think, as we go into this year.
Okay. So do you think that some companies are still playing defense and deleveraging, or are you starting to see more debt finance transactions?
I can't. So the names that were most impacted by the reflation cycle, the sort of hardest hit, whether they saw the most number of ratings downgrades or now they're high yield, they are still playing defense. So if I look at my double B universe, for example, if I look at like an Austria or a CPI or even Heimstad Boesdad, which is low triple B, these companies are still focused on making disposals as we start 2026. For example, they're not ramping investment yet. They're definitely not ramping shareholder returns yet, although in the case of CPI, they've just continued to make shareholder returns. So there are some companies that are still there. I just think in general, they're the minority. And yes, a lot of the investment we see is debt funded, at least partially, if not all. And some of that is just single asset acquisition, portfolio acquisition. Sometimes it's adding to the pipeline, so increasing development activity or CapEx. That investment comes in different forms for a real estate company, but in general, it is increasing in IG.
Okay. And then, like, how is that translating to sort of transaction volumes? You mentioned a little bit of that earlier, and sort of how are you thinking about that pace of transaction volume, picking up or sort of stable this year?
I think it will help on the transaction volume side, but obviously the real estate sector, when you're thinking about transaction volumes, is so much bigger than REITs and real estate companies, in the sense that it, like, if you think about like funds, for example, or pension funds, real estate funds, like they are really the private market, like huge players. So you need everyone at the table to see a really healthy transaction market. And my guys are starting to spend again from a low base. So I expect them to support stronger transaction volumes next year, but definitely not to be the ones that like really tip the scales one way or another.
Okay. And then, with that, comes potential for, some M&A is always that's sort of swirling in the background. That tends to be the most impactful, I think, from sort of a net supply perspective. When it comes to bond issuance, how are you thinking about M&A volumes this year? Are you seeing some signs of consolidation already?
So I think on the M&A side, and maybe this implies that my companies are still slightly more defensive, I don't expect to see a lot of property companies buying other property companies, at least for my coverage universe in 2026. Now,
Okay.
that has to do with just like a degree of prudence and the fact that when these companies are looking to create value, they can do that in different ways. Like they can buy land bank, they can buy a building that needs to be refurbished, they can buy a standing asset adjacent to their existing assets, they can buy a portfolio of assets. They have a lot of different ways they can invest, which is not consolidating, it's not buying a peer. That being
Okay.
said, real estate equities are still hugely depressed. So if you look at the indices, for example, they're still down by over 35% versus pre-reflation cycle highs. And a lot of real estate investors look at the equity market and they're like, this is cheap. This is cheap versus where the underlying portfolio is valued. It's cheap versus historical. So what we have seen over the last year is actually some funds look to buy public companies as a way to capitalize on that. It's possible that my coverage also does that. It's just not my base case expectation at this stage, but it's definitely something to bear in mind because that thesis for value creation would hold up.
So I guess you mentioned like depressed equity valuations. Like are companies starting to shift their focus towards that shareholder return mechanism away from being sort of more creditor friendly?
Yeah, and I think that is interesting. So now we've seen Koyamo, Boulder, and most recently Aroundtown announce share buybacks. That is definitely a change, even from, if you look back at 2021, share buybacks was not the primary way these companies were looking to deploy capital, but they're looking at their floats and saying, this looks too cheap, and I'm going to put some cash to work. And that is, I get negative for credit investors. I think those will increase also if companies make more disposals. So real estate companies are always looking at their portfolios and saying, right, what should I be buying? What should I be selling? And in recent years, when they've been selling, those proceeds have been used for shoring up the balance sheet. But now I think those proceeds, if they're not redeployed for investment, which in theory should be a positive for creditors, especially if it's done by a smart management team. If that is redeployed for share buybacks, that is more negative. We've also seen most companies restart dividends. I expect of the few that haven't to restart them this year or early next year. So, but the dividends in many cases actually have been rebased to more sustainable levels, either through a change in policy or a change in absolute levels. So it's slightly different than the share buyback, but the step up in shareholder returns is definitely something we are monitoring. And if those were to be debt funded, that would be a red flag in my view.
Yeah, big shift from the depths of the 2022 to 2023 crisis in the space. All right, so Mary, what does this all mean for the outlook for credit metrics?
I think your best case is on average LTVs are sideways, on average, with some going up and some going down next year. I think it's definitely possible that LTVs on average creep higher, especially for the IG names. A lot of companies are expecting to be able to offset any increase in debt with higher valuations, property valuations, but I think it's not a given that those will tick up at the same pace. And there is some lumpiness always with investment.
Right.
What is available? How big is it when they choose to deploy the cash? So cautious on the outlook for LTVs and cautious on the outlook for interest coverage ratios. But the drivers there slightly different in the sense that really the primary headwind has to do with the refinancing of legacy low-cost debt at current market rates, which is only partially offset by EBITDA growth. So that I expect to continue pretty much regardless of capital allocation. And the capital allocation shift I expect doesn't help the outlook for ICRs. So yeah, probably best case scenario, flat LTV and more than likely weaker ICRs this time next year.
That's helpful. I mean, we'll get into sort of like your recommendations in just a bit, but before we do that, let's kind of shift to the primary market. You mentioned refinancing needs. What are some of the trends that you've seen in terms of bond issuance in recent months?
It's been a strong start to the year in the primary for the real estate sector. We've seen a lot of riskier names come to market, so a lot of crossover names, wider names. We've had a hybrid from Heimstad Boesdad and Aroundtown launch. And in general, these issuance have been well received. Very little new issue concession, and all the bonds have tightened. I was checking this morning, at least the ones that I'm tracking, aside from the Aroundtown hybrid last week. So in general, it seems like a strong start to the year, which is helpful for the issuers as they look to raise more capital in 2026.
Do you think that's kind of reflective of like the broader market strength and resiliency we've seen, or is that more like more faith in better relative value in real estate that investors are looking?
I think probably a combination of both, in the sense that supported by obviously a strong start to the year across Euro IG, Euro credit, and also the fact that real estate is wide. So it is compelling just from that RV perspective. Like if you compare three issues in the market from three different sectors, there's a good chance the low BBB real estate name is going to be the widest. And then I think it's a sector people feel like the blow up just happened. So are you going to get another cycle? Are you going to get another repricing downward of 20% over the next 2 years? No, it's highly unlikely. So I think that it's versus like a confidence in the sector. It's more about that RV piece in the current environment.
Yeah, makes sense. I mean, the reach for yield is definitely still very robust.
Alive and well.
Just yeah, no, it's like any headline is sort of good news. It seems like in the market today, but we'll see how that shakes out over the course of this year. But in terms of this year, what are you looking for in terms of primary market activity?
I expect continued consistent supply. So I think I've estimated around just over 20 billion of senior maturities this year for Euro and Sterling IG for the sector. And then there's quite a big maturity pillar in the first quarter of 27. So I expect a lot of issuers to be proactive terming that out this year. A lot of the real estate issuers have pursued to date this year and in recent years LME, which I expect to continue. That usually means a new issue alongside a tender focused on a few different bonds or sometimes one bond, but that can either be taking out front-end maturities or making an offer to front-end maturities or targeting low cash price bonds in an attempt to reduce debt. So I expect LME to continue, which will drive supply. And I expect more hybrid issuance. We have a lot of first calls in 2026, which will bring names like Heimstad and Aroundtown back to the market. And obviously now the hybrid market is open to more of these issuers. So we are seeing less exchanges. So all of those should support supply and more of that investment, that I mentioned. I think a lot of investment will be partially, if not all, debt funded. So that will also drive an uptick in supply volumes in 2026.
Yeah, definitely. I mean, our view is a little bit more on the side of like we thought volumes in general would be a little bit lower this year, but I mean the primary market's off to a red hot start this year. Just kind of I think illustrative of just really strong demand for corporates. So we'll have to see how that shakes out. But yeah, it's been a busy for sure start to the year. We'll see how that can continue. All right, so let's move on from the primary to your views in terms of the risks and the outlook. You moved to a market weight on the sector in 2025. What do you need to see to get more bullish on your sector? That's already recovered pretty nicely from sort of a valuation perspective in particular versus the rest of the IG market.
So I do struggle with this question, and so it's definitely one worth asking, in the sense that real estate trades wide versus the IG index, and even if you look back at 2021, prior to the reflation cycle, low interest rates, an incredibly supportive environment for European real estate, it was, I think, at the lows like 17 basis points back. I think now it's around 18, so we're kind of there in the sense that that was a more supportive environment and we're back at those tights. But as we mentioned, the reach for yield is alive and well. So will real estate continue to outperform on carry? I think it probably will. I just struggle to make the case it should tighten meaningfully towards the index. And a lot of the reason I think it should provide the spread compensation has to do with, for lack of a better word, sort of structural issues with the sector. The first being governance as a concern. And obviously the real estate sector has some sort of infamous examples of this, whether that's like Adler or SBB being downgraded from IG to CCC in 3 months, the swath of short seller reports, accusations of fraud. Now, I'm not saying that a large amount, or it's very few issuers where that is a concern, but it does sort of overhang the sector. And then, so there's that sort of the like unknown unknowns. And then you also just look at sort of standard governance practices, and there are some sort of obvious causes for concern. For example, you have a lot of private companies with poor disclosure. So they'll only disclose twice a year and not hold conference calls. You have companies that are issuers that are issued from a fund structure. So for example, I cover Blackstone Property Partners Europe. It's issued from a Blackstone Core Plus real estate fund. If you compare that to, say, a Vonovia or a large public issuer, then you have the whole equity market helping you understand, okay, what does equity market perceive of that property value, and you understand exactly what's being communicated to equity and credit investors. So you have more clarity there. You have a lot of tightly held companies in real estate, so where the founder, largest shareholder, would also be the manager. Lots of instances of related party transactions. For example, development is often done at a JV. You have companies that lend to their JVs, that buy assets off their JVs or their subsidiaries. All of this sort of just muddies the water of what I think you'd want in terms of textbook good governance. And we've seen how painful bad governance can be. So it's difficult to handicap it. But I think it is one reason why the sector should and does trade wide. It also has a long tail of small issuers. It's less concentrated than, say, if you're looking at telco or utility. And, credit metrics, like I keep saying, are weaker than they were when we were at these tights in 2021. So all of that is why I'm like, yes, it's wider. Yes, it may outperform on carry. I'm comfortable reaching for yield on specific names, but for the sector as a whole, I think market perform is the best way to describe the level of risk I'm comfortable taking.
All right. So, sort of that premium embedded for some muddy waters that you mentioned. Is that like the biggest risk that you're thinking about, or is that what you're most worried about in general, about kind of where things could go wrong, or is there something else?
That's perennial. If I think about sort of what could go wrong over the next 6 to 12 months, I would probably highlight two. The first would be, keeping an eye on what's going on with offices. Starting the year more optimistic, but we could see vacancies tick up higher. We could see transaction volumes fail to bounce. We could see AI seriously impact hiring, which would be a negative. Desk job creation is the major tailwind for the office sector. And if AI impacts that would be a negative for the sector. And then also a tightening in financing conditions, because ICRs are such an issue. If it becomes more expensive for all issuers to tap the market, that is a real negative for European real estate. If their cost of financing goes from 3 to 4%, from 4 to 5%, and that also has knock-on implications for the hybrids and could create a lot of volatility, especially in the shorter duration first call hybrids. So those are the two, risks I would be watching going into this year.
Okay. Yeah, that's really helpful. And I guess, we did publish a kind of Euro strategy overview of the key risks for 2026 on the 27th of January. So for anyone listening to the podcast, I highly recommend checking that out for our kind of cross-sector analysis on each key risk within the sectors. So Mary, let's talk about kind of relative value. Can you give us an overview of how you're thinking about positioning within real estate in 2026?
So there definitely are some spots where I am comfortable reaching for yield. I think I just sort of covered why I'm still a market perform, even though it still offers that pickup in this current environment. That's for the sector as a whole. But I think, if I break it down, I'm like, and I look at my outperforms skew towards mid to low triple B credits, for example. Like it skews to names where you are getting that pickup. So the sector gets the pickup versus the index, and then these are names which are wider within the sector. So that should be compelling. I think a good example of that is Heimstad Boesdad, which is low triple B. It's a name with a really strong asset base focused on residential. It's still playing defense, like I mentioned, which I expect to continue for the first 6 to 9 months of the year. I expect the LTV to continue to improve, and the ICR has gone through the trough. So it's a place where I'm like, okay, I'm comfortable reaching for yield in high BOS, which is a nice way to play the real estate sector as a whole.
Okay. And then are there sort of pockets that you think are more compelling, or is it, all about sort of single name credit selection this year? What do you think?
In terms of other subsector pockets, we're positive on Central and Eastern Europe logistics. So that's names like VGP and CTP. We expect continued strong growth from these players, which I think is reflected in the equity of both of those names. So that's I think another example of an area where we like the operating outlook. So we can get comfortable with, say, a higher level of spend in terms of investment because of their development arms or some other things which may give some investors pause. So yeah, there definitely are some other pockets as well. But it is more of that name specific, small pocket specific, not like all of offices, all of French REITs, for example.
Okay. And then, I think, we all know that spreads are sort of near their cycle tight, so it's difficult to just go outright and expect compression, continued spread tightening to really drive portfolio performance. One thing we've been advocating for is being really selective in terms of curve positioning, trying to sort of play it for carry and roll down rather than compression. How are you thinking about curve positioning within real estate specifically?
So we think the sweet spot is the 5 to 7 year maturity bucket. It offers compelling spread pickup versus the index, comfortably over 20 bibs. And I think there's potential for some of those bonds to also benefit from further LME, like I mentioned. And I expect most of the supply that comes in the sector to be slightly longer duration. So a combination of attractive pickup, and I think potential roll down from LME as the companies look to proactively manage short-term maturities. Also, if you're comparing the real estate sector versus the index by ratings bucket, the other bucket that really stands out is actually 10 plus years. So I just think it's worth mentioning that the reason we are not as bullish on the long end for real estate is because it has that sensitivity to government bond yields. I think you risk, if there is, a further steepening or further step up in 30-year governments, you could be impacted from a total return perspective, just like all long on bonds would be. And then you have the added headwind of the credit being negatively impacted. So you kind of double down on that risk in a way that we would prefer, that we think merits that greater spread pickup that you see.
All right, that's great. And also sort of aligns with the way that we're thinking about the market from a strategy perspective too. So that's great. What about seniors versus hybrids? Is there still any value in terms of going down the capital structure?
So we were outperform the hybrids for all of last year, which is a trade that worked out great for us. And now they've tightened hugely. I mean, they look much more like a performing hybrid asset class. So we've taken off that broad-based outperform for the names we like Heimstad, definitely comfortable going down the capital structure in those hybrids, just bearing in mind there is a higher risk of volatility and making sure you have the pickup to offset any periods of vol that could arise. And then we also have some security specific hybrids that we like, that we outline in the outlook, where we think the pricing, there's this attractive pricing disconnect. And it'll be interesting to see, I think, what happens in the primary this year with the European real estate hybrid market. That could create some opportunities.
All right. So with all that said, let's wrap it up with a speed round of your picks and pans for real estate in 2026.
So top picks, I already mentioned Heimstad Boesdad. I mentioned VGP briefly. That's one of the Central and Eastern Europe logistic focused players. It also has a relatively complex structure, and I think that weighs on spreads more than is merited given the value of the asset base. We also recently moved to outperform on Blackstone Property Partners Europe, preferring it to Logicor in particular. I expect spreads between those names to invert this year. And then our primary pan is Austria. Austria is a double B German player focused on offices, and its strategy is to essentially buy assets that need to be redeveloped, which means its portfolio now skews to assets in need of investment. And we think that is a higher risk portfolio in the current environment, given the pressure on office assets, and given that a lot of that stock that needs to be redeveloped, was bought in an environment with much higher prices across the board. So that'll make generating positive gross margins much more difficult. They also have potential ICR concerns. So most cautious on Austria.
All right. That's super helpful. We've covered a lot today, and I think you've definitely boiled down, a really complex sector into some key kind of talking points for this year. So really appreciate your time, Mary. Thanks for coming on, and I can't wait to do it again soon.
Yep. Great to chat.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.